another weird, sneaky issue that is happening behind the scenes that is not really explained. It's not promoted in the media. There's no real discussion about it. But this is... Welcome to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Broch Lassig, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth.
All right, so we're talking about mortgage rates and why they haven't come down. We all expected them to come down faster than they have. I know I've talked to tons of clients that were like, wait till after the election. You know, the Fed, well, actually, it was, I'm going to wait for the Fed to drop rates. Fed drops rates. Rates don't drop, they actually go up. Mm-hmm. It's like, I'm going to wait till after the election. Rates continue to climb. And it is a confusing situation. And frankly, I think it's weird because we've been in the business a long time, both of us. Mm-hmm. And it's still confusing for us. All we do all day, every day, is track the market, understand the industry, figure out what rates are doing, why they're doing what they're doing so we can guide our clients. And it's still been confusing for us having to learn because it's such new economics.
Well, especially because we're very analytical. We look at a candlestick chart of what mortgage-backed securities are doing, and they should be doing one thing. But at the end of the day, headlines trump candlestick charts 10 times out of 10.
Mm-hmm. And the economics of just what we're dealing with are different than they've been in a long time. So maybe...
But why? The question is, why aren't they coming down?
Exactly. That's what I was going to say. Let's explain. Because we have learned a lot over the past few months.
The main thing for me is rates aren't coming down because our economy is doing too well. Mm-hmm. Now, what is that too well? I mean, it's they're tracking jobs numbers and inflation still.
Mm-hmm. Well, and that's the thing. So, like the Fed... Everyone was like, hey, we're waiting for the Fed to drop rates. Once the Fed drops rates, the path downwards is going to be certain.
Yep. And
it's not. And primarily because the Fed funds rate, we've said this many times before, but the Fed funds rate actually doesn't influence mortgage rates at all. Mm-hmm. It's the reason why the Fed is doing what they're doing and the Fed's sentiment. Like literally the words they're using in their press releases is what's moving the rates.
Yeah, that has more effect on the rates than
not whether they move the Fed funds rate or not. At least on mortgage rates. Other rates, it's a direct impact, like your HELOCs and auto loans, credit cards. Those things are coming down in real time with the Fed funds rate. But what we're dealing with, to TJ's point, is the Fed basically talked about a dual mandate where they had to control inflation, in other words, prices, and they have to control jobs within the economy or unemployment. Those are the two things they have to have a grip on to keep the economy stabilized. And inflation was handled, and it's continuing to go down and going in the right path, and they keep expressing that. But the issue is we see this employment, to your point, where it's like employment is strong report after report, but the annoying thing is that you actually mentioned is the headline numbers are strong. Mm-hmm. What no one's paying attention to and the market isn't moving, which is frustrating for us guiding our clients, is the revisions are terrible.
Yeah.
But the market's not reacting to those revisions.
No. And if they did, we would probably be in a lot better rate position than we are now.
For sure.
And that also speaks to the election, right? I think everyone thought that with the election is going to bring lower rates, but and it doesn't matter which side you're on, but with the election, there's a lot of sentiment going up in terms of what the economy is going to do. And if the economy is pumping more, there's fears that with a more booming economy could bring more inflation.
Yeah. Yeah, that's the confusion, too. After the election, many clients were like, hey, you know, what didn't matter which side of the fence they're on. We're going to wait. And Trump got elected, obviously, and everyone was like, why are rates continuing to go up? Well, the reason is
I wasn't in the business. Sorry to cut you off. I wasn't in the business. I was just getting into the business last time Trump got elected. But from my understanding, didn't rates go up like a full % overnight when he got elected?
Yeah, yeah.
Right.
Like within by the next business day, they spiked like at least somewhere between 3/4 and a point.
Right.
Something like
That's
that.
why I'm like, I don't know where the expectations came in that if he were to be elected again, rates would
Agreed.
go down.
It's weird,
Uh-huh.
but the reason for that, and the reason it happened last time, is because Trump, as the candidate and the president, is viewed as a more pro-economy president. He will promote business more and therefore create more boom in the stock market. And when there's a greater boom in the stock market, there's more strength in business growth. There's less of a desire to invest in bonds, treasury bonds or mortgage bonds. And the investment in mortgage bonds is the exact, that is the reason rates either rise or fall, is the demand in mortgage bond investments. And because he got elected, that's what we know. That's what we understand.
Right.
Why the sentiment was different, I don't know why that was the case. But that's why it's happening, because he's just such a pro-business president, and they believe the economy is going to boom because of it. One other thing that we wrote down, which is crazy, because really it's difficult for us because so many of our clients are like, hey, I want to wait. Why are rates not falling? I heard the Fed dropped rates again. What is the deal? Like, rates have come up 0.5 point since we've been in this whole game. We got many clients that have been sitting, waiting to lock something in, waiting for some of these things to take place over the past few months, and rates have just continued to climb, and it's been frustrating for them. Another weird, sneaky issue that is happening behind the scenes that is not really explained, it's not promoted in the media, there's no real discussion about it, but this is, the U.S. has a massive deficit. We are in insane amounts of debt, and it just continues to go because of that debt. The cost to pay the interest on the debt that we have, the way that those payments, so the country doesn't go bankrupt, the way we make those payments is the U.S. Treasury issues new Treasury bonds. So like 10-year Treasury bonds, which are very closely related to mortgage-backed securities. But all different types of bonds, anywhere from like 1 month to 30-year treasuries. Those are continually being issued at record rates because we have to keep up with the deficits and the debt that we have in America. And when that happens, this is another reason, and actually a caution to how low can rates actually get going forward, because the debt situation, which we've learned through this election cycle, it's a very significant issue that nobody really has a solution to solve.
When is that issue coming up again? The
budget
ceiling?
I don't know about that.
Yeah.
I don't know about the debt ceiling.
Do they correlate though?
Probably. I mean, I don't know that correlates necessarily with this, because whether there's a debt ceiling or there isn't a debt ceiling, there's still an insane amount of debt with payments that have to be made. And the way those payments are made is by raising funds with the U.S. government through Treasury bonds. Yeah. So Treasury bonds are considered a safe haven asset because they're backed by the full faith and credit of the U.S. government. So it's like, is the U.S. government ever really not going to pay? I mean, probably not, because they could just print more money. But the issue is they keep being required to issue more and more and more treasuries. When they flood the market with all of this supply of treasuries, no matter what is going well or in line with the idea that mortgage rates should fall, it creates competition to investing in mortgage-backed securities because there's so many treasuries coming. And the same buyers, like, you're going to buy treasuries and or bonds for your safe investment. So if there's more treasuries coming on board, they're going to err towards buying treasuries versus buying mortgage-backed securities, even though they're both considered safe bonds.
Makes sense.
It's safer to buy a treasury, and they're just basically flooding the market with too much supply, which is stifling demand for mortgage-backed securities because they're opting for this excess supply of treasury bonds. So I think that's a bit of a concern going into the future. Will rates actually fall? I mean, I think our opinion is similar in that rates probably aren't going to fall until we see a significant recession. Now, some of the Fed's actions could be leading us that way, but.
So what are your thoughts on Elon's new position?
I know, that's crazy.
Do you think that this helps at all?
I don't know.
Because it's interesting. He tweeted out something like last week that was like, the reason that U.S. is in this position is because of the amount of debt the U.S. is in, and they've caused inflation. So I'm curious to see if
it's going to be awesome
on that. Right?
I'm a fan of it.
I am too. I mean,
like I've always said, you like social spending programs and things within the government are necessary things. You have like, there are like, my sister-in-law, for example, she is in a full-time care facility because she's disabled. And it's like, I believe that those things are needed. Like we need some social funding for certain things. The challenge is
there needs to be some checks and balances.
Exactly. There's no accountability for it. So you've got a bunch of people abusing the system constantly. And hopefully that's what the Doge
whatever it stands
solves,
for.
Department of Governmental Efficiency.
There, he's got it memorized. There we go.
Hopefully that's what they solve for.
Yeah.
Because it's just like, and I agree with that. Like, come on, let's create some accountability, because the reality is it's scary stuff. Like, a lot of us want to get caught up in the glamour of the elections and, which party do you, who's a jackass and who isn't a jackass in the elections. Like, we all want to get caught up in the glamour of it, but the reality is, like, we're all Americans.
We're all working towards the same thing.
And we're in a pretty dire time that almost as certainly no politicians want to admit. Like, we are careening towards a path of, we may already be on a path of no return. Like, at some point you got to pay the piper, and hopefully this is at least a step in the right direction.
So what do you think is the quickest way for rates to come down? I mean, in my opinion, it's the jobs numbers. When you see more jobs lost, which sounds bad to say, but it's true. I mean, because that's showing that if people are losing jobs, they can't spend money. And if they can't spend money, then inflation's coming down.
Yeah, that's the crazy thing, because what we've talked about, which is also weird, because some of this data, so like the jobs and economy, the jobs continue to be so-called strong, and the economy is good because I actually posted on social media the other week about, like, if the U.S. economy is a consumer-based economy and consumers are spending all on credit, because the crazy thing is jobs are supposedly fine, consumers are strong and continue to spend, but at the same time, you see way more part-time jobs being taken. And they say not for economic reasons, but it's like, why else would there be so many part-time jobs? Like, there's a flaw in the data.
Or pay decreases.
Exactly. Or an hourly decreases. Like, there's a lot of this data that's kind of like shadowed by headlines, but you look at the credit, the amount of debt, not only with the U.S. federal debt, but just consumer households. Every month we hit a new record of credit card debt every month. And we're not even seeing, which we recorded a while back, the buy now, pay later. We're not even seeing that reported in its entirety in that revolving debt balance, which is crazy. So it's like, it's a house of cards is what I see it as.
There's no direct correlation, but what's crazy is, and maybe it's a fluke and maybe we're just noticing it more, but I don't think it is, because we just track our business so crazy. I mean, realistically, our opportunities, the amount of business we're doing, the amount of people we're talking to per month, it's about 60 to 70% what it was 2019. Right. And I'm seeing the list of people we have that are unemployed, that have been laid off in the past couple months, double to 3x the amount it normally is.
Well, it's been longer than that too. I mean, it is gradually getting worse, but it's been, you think we started seeing these layoffs, I mean, almost a year ago within our own little business. Which I think that's why we have somewhat of a different view on what the economy's doing, why we feel so convinced there is going to be a recession if we're not already in one, because we see on a micro level the real world situations. We see clients calling us saying, I can't buy anymore because I just got laid off, or I need to refinance my 2.75% rate to a 6.5% or 7% rate because the debt burden I have, because I can't afford to keep up with everyday spending, is overwhelming, and we have to refinance. We don't want to lose this rate, but we have to do something. I need a HELOC. Like, we're seeing that in real time. Things are not going in a positive direction.
No. And that's what's so confusing to me. And that's why I just wait for the revisions every single month on the jobs report.
But it's so frustrating because nothing happens.
Nothing moves.
But the scary thing is that I think about, we talk about this a lot. It's like, the longer we go without a recession, and the higher the Fed keeps rates for longer, and the better things seem to be, I just feel like it's an arrow being pulled back tighter and tighter and tighter. And the velocity of how sharp and violent a recession is when it comes just keeps getting worse and worse the longer we go.
Right.
Like, at some point, it's going to happen.
Right, for sure. Which, I mean, I think goes to show that if you feel that you, like, you know, if you're in a situation where you've got credit card debt or something like that, take care of it now while you have the opportunity to, not before it's too late. Because there's been several people that we've been helping over the past couple months that had to cancel a refinance because they got laid off, but they needed to do that refinance to pay off debts.
Right, for sure. Yeah,
so just get ahead of the curve.
That's what we call risk mitigation in our business, is like get proactive in putting yourself in a position where your finances are, we call it financial resilience, where you can encounter the unexpected and get through it just fine because you're proactively in charge of your finances, not being focused on one thing and being stubborn about addressing it, assuming that nothing bad can happen because it can. And I think, I mean, my opinion is it's coming, and we're doing the same thing, like within our own households.
Yeah, I've got a HELOC out in my house,
prepped, and ready, and it's like you've got to be engaged, and you got to be realistic into like what is possible and how do I guard myself against it. Because the other thing that I think about for my family in particular is like, yes, be guarded against the risks and the concerns and the possibilities of something negative happening. But on the flip side is if I'm prepared and I have liquidity and I have stability and I have financial resilience, like we call it, and there is a downturn, well, that's where you get really rich, is if you have the ability to make offensive moves in a downturn.
Yeah.
Exactly, during a defensive time. And it's like so many people get their head just stuck like, I can't, you know, I don't want to buy for this reason, or which is just holding you back from creating wealth, or I don't want to refinance or, you know, change anything on my mortgage because I have a super low rate. And it's like, sure, that's good, but it's not the only thing. You got to look at the whole picture and get prepared.
It's true. And realize we're I mean, in the real estate game right now, I think that this is that downtime. We were talking about the other day.
100%.
Full disclosure, we didn't want to do the podcast today. So like, what the hell do we talk about? And you said, dude, it's not sexy right now. Like, no one wants to talk about real estate. We want to talk about Bitcoin because you go to your hairdresser or the shoe shine boy. They're talking about Bitcoin.
Yep. That's what we were talking about on Friday.
Yeah. So it's like, okay, make the moves when people aren't making the moves.
Because no one wants to talk about real estate right now. Why? Because it's not, people aren't winning in real estate, but they are, right? Because the people that buy today and take the chance today and get in today are going to be the ones that everyone is talking about in 1 or 2 years from now when the boom re-ensues in real estate. Like,
by that time, it's too late.
Exactly. It's like you should have been buying Bitcoin 2 or 3 years ago when it was at like 20 grand, and now it's at 100. Not today when it's at 100. Like, when everyone's talking about it, you've missed it by probably a year or 2 or 3. You know, it's not like it's not like you're hearing about it and you're like, "Oh man, I'm at the, you know, I'm at the front end, I'm at the cutting edge." You are not. You are so far behind. It's when people aren't talking about it where the opportunity is, which is crazy. And I mean, kind of brings us back full circle. Like, people obsessed about why are rates not falling? What is the answer? We thought rates should fall when the Fed dropped. We thought they should fall when the election was done. We thought they should fall so and so. It's like, you can't time the market.
No.
You cannot time the market. You have to just get in. You got to have faith. You got to understand that you're getting into an investment in real estate.
Make the most educated decision, of course, but don't have analysis paralysis.
And don't try and time it, because it's a matter like what happens today or in the next 6 months. Just like if you bought in the S&P, you buy in the S&P at the very peak. Who the hell cares if you bought it at the very peak 20 years down the road?
Right.
It doesn't matter. That peak is going to be, you're going to make tons of money no matter what, even if we see a huge tank. Same goes for real estate. Like, it's a long-term play. It is a wealth creation play over the long run to create legacy wealth and more financial freedom for you and your family in the future. It doesn't matter what happens with, like, you can't time it.
No, you really can't. You really can't. And your future self will thank you. I mean,
100%.
it's, you know, and buying's not for everyone too. If it's only 1 to 2 year plan, maybe it doesn't make sense.
Right.
And that's where we'll advise you. Yeah. You know, our consultation's free.
Yeah, so for sure. And we have a vested interest in helping you be as successful as possible in real estate, not in closing your loan. It's really developing a level of trust so that we can be the resource forever and always, not to just quickly get to a transaction. So we'd love to guide you through this, have a more specific one-on-one discussion on what your questions might be, why rate, we can go into more depth as to why rates aren't falling, so on and so forth. We'd love to be a resource. So
sweet.
cool.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.